Thanks everybody for jumping on here. We're excited to present the Timbercrest Apartments and Townhomes deal. We are basically looking at this. This is a Meadville property. It's a 102 unit workforce housing complex in northwestern PA. For those of you not familiar with the Meadville region, we have two differentiated investment opportunities for you guys today. Those are over a 4 and 10 year term target timeline. We're looking for $50,000 or greater checks from accredited and non-accredited investors. Awesome. So a quick disclaimer, and then we'll get into it. So this is an investor overview. It's for informational purposes only. We will provide a legal document with full disclosure of matters discussed in this overview and the materials that we provide ahead of time for you to review ahead of any investment. And so today we're going to jump right into the investment summary, and then we're going to look at the asset, the market insights. We'll introduce the team, and then we'll talk next steps. So for those of you who don't know, my name is Patrick Rice. I'm the CEO here at Rice Pegher, and I'm going to start off, and then I'll kick it over to the CEO in a few minutes. So let's take a look at the investment summary. This is a workforce housing opportunity. And so when we talk about workforce housing, we're talking about affordable, non-subsidized market rent apartment complexes or townhomes, targeted really towards a blue collar worker. Somebody who works in the service industry, construction, manufacturing, that kind of thing. And in terms of the Timbercrest opportunity, that's exactly what this is. And this is what Rice Pegher seeks out, and this is what we specialize in. The location itself, we feel is great. It's a stable market with outsized demand for this exact type of product. In this area, housing is certainly a need and not a luxury. There's a lack of housing for people at this price point, and this asset is currently not exactly well positioned to service that market, and we can do that. From a competition standpoint, essentially there's no new competition in the pipeline at our price point and at our scale for Timbercrest. It's frankly impossible to build workforce housing at these affordable price points without government subsidy. The cost of construction is just too high. And there are no projects in the pipeline scheduled to come into this market that we're aware of. And there's frankly none that exist that are going to be to the quality of the product that we're going to produce. So we do have the opportunity to become the premier workforce housing complex in Meadville in the greater area. Not only from a physical product standpoint, when we think about fit and finish of the asset, but also from a service standpoint. And we'll get into that. So these factors all kind of combine to create a really stable investment opportunity. Basically, outsized demand, lack of competition, best in class from a quality perspective are going to let us implement our standards for tenants, and basically make sure that we're placing people that fit our requirements, that ultimately lead to longer tenures for staying, less bad debt, and frankly, just a more stable asset. And then from a macroeconomic standpoint, inflationary environments favor investments in hard assets. That's why we love real estate. We love it in most macroeconomic environments, but especially one like this. And so these kind of factors kind of set the stage for Timbercrest and for our business plan. And I'll dive into that right now. So we're buying this correctly. So we're able to buy this at below replacement costs. So basically at $75,000 a door, and we're able to assume attractive debt. So we're taking on $6.5 million in Freddie Mac non-recourse debt as part of this deal. It's locked in at 5.32% through 2029, so below what we can currently shop for, and we think that's a great basis to start this project. It's a value add project, which again is right down kind of our sweet spot or our pipeline at Rice Pegher. We're a hands-on group, and we typically seek out assets that need a lot of TLC, and this is certainly one of them. We're going to hit the ground running with an immediate renovation of 50 classic units, so about half the portfolio in the first year or two. And then we're going to have an immediate package to improve kind of the exterior. So the landscape, the exterior of the buildings, the parking lot, which is in terrible condition, common area improvements. So we're basically going to jump in the first year and drive a ton of value, which you'll see resulting in the numbers once we get to that section. We're also going to improve operational efficiency. The big opportunity here is that this asset has been very mismanaged for the last 5+ years. Currently operates on pen and paper. It is extremely disorganized. It's one of the first things we noticed when we went and toured the property at the beginning of this process. We are a vertically integrated ownership group. We have in-house property management and maintenance as well as construction. So we're able to control the physical product and the service product that we're going to deliver at this location, and immediately improve everything with integrating technology. So we have a very simple app that residents can use to pay their rent and to submit tasks, and we're going to implement that right away. Outsized demand. So I touched on this in that earlier slide, but really there's an outsized demand for this type of product in this market. There's actually a waiting list for applicants to get into Timbercrest, yet it's only at 82% occupied. This speaks to kind of the poor management that's been in place. There are downed units that just either don't have the funds or the manpower or both to get them turned. Simple as HVAC units and paint and cleanup. That's not getting done, resulting in a very kind of a big vacancy rate that we're going to correct very quickly once we get in here. And again, there's a lack of competition for amenitized workforce housing at this scale. So this is the business plan that we're bringing to this project. This is why we're super excited about it. And I'm excited to dive into some of the investment highlights here. So the purchase price on this property is 7,725,000. We're going to bring about 1.5 million in capital improvements to the project for the exterior and interior improvements, which I discussed. And then, there's about 785,000 in closing costs, reserves, operating capital, and fees for a total capitalization just under 10 million. The property is about 45 years old, 47 years old. Comprised of 102 units. And as I mentioned before, occupancy hovering right around 82% currently. So from an investment overview perspective, as I mentioned, there's going to be two options, and we're going to get into those on the next slides. Each of them offer unique return profiles and terms. So depending on your preference, you can select one or the other or both. We are prioritizing the LP in both situations in terms of repayments and weighting of the deal. And Eric will speak more to that in just a second. And this also includes a cost segregation study, which we do in basically all of our deals, which allows our Class B partnership interests in this case to participate in the forced depreciation, which allows you to offset passive income. So we'll get into that as well with more examples as we go through this. So I'm actually going to kick it over to Eric Rice, CEO at Rice Pegher, to dive into the details of the investment. Eric, you want to go for it?
Yeah, thanks, Pat. So jumping in here, we'll just kind of do a quick overview of both of the partnership interest classes. Class A is going to be a $500,000 tranche. It's pretty simple and straightforward. It's approximately a 4-year target hold term, and it's just an annually compounding 9% return with a balloon payout at the end of that approximate 4-year timeline. I'll show you those returns on the following page. Class B partnership is kind of the interest for investors that are really interested in long-term quarterly cash flow and the strongest return profiles in the project. So the Class B partnerships are really kind of riding with the project and are in for the 10-year term that we're projecting. These are basically split. We're doing a 70-30 split. So 70% of the deal goes to the Class B partnership LPs and 30% goes to the general partners. Minimum investment, like Pat had mentioned earlier, 50,000, and our tranche for that is a $3 million raise on the Class B partnership interests. We can get into the equity multiples and IRRs on the following page. So this is just an outline of what your investment returns are targeted to look like. The Class A, again, is compounding 9%. So if you look at that $100,000 example, it's pretty straightforward. You just see a compounded 9% with a balloon payout in year 4. We achieved that balloon payout through the refinance at year 4. That is the time when the current debt expires in 2029. And that is the time when we anticipate being able to kick back a good bit of funds, including the Class A partnership interests in full. The Class B partnership interest, if we look at that at $100,000 level, you can kind of see the cash flow as we go year to year. You'll notice year 1 is a 0. That's because that's kind of our year to do all of the CapEx that Pat outlined. and get this property up and running in a more professional manner and in a sustainable manner. So we start those distributions quarterly in year two, year three, and then you see year four, there's a big bump. Year four, again, that's that refinance bump. We are doing 100% return of refinance proceeds to the limited partners, the Class B limited partners there. So we're expecting a return about 60% of the initial investment in that refinance. And so you'll see that plus the cash flow from that year and that year four, which is why you see a high number there. And then the remainder of the deal, you're just going to kind of watch it ride out. Uh, those are your annual totals of return all the way through year 10 when you see the sale bump and your, an additional equity return. One important thing I just want to mention here that we do or we're doing on this deal that may be a little different is we are not as general partners participating in the equity split until the Class B partners are 100% paid back from their initial investment. So if you invested 100K, we're not participating in any of the equity split until you've gotten $100,000 back through a couple of methods, none of it being the cash flow that you're seeing on an annual basis, all of it being refinance proceeds. If we ever did an additional loan on the project, return from that and or the sale proceeds. So once we hit, say, $100,000, then the 70-30 split takes effect. So we're trying to prioritize the LP returns ahead of the GP equity split. Some highlights down below based on our model, and these are kind of typical metrics that we see in our industry. Uh, we're projecting a 13.64% average annual return, 2.6% equity multiple, and a 14.22 IRR on this project. So really solid metrics, and we're super excited to kind of bring this out to you guys. I also wanted to just run through a quick return scenario here and show you, our projections and our pro formas, our business plan is kind of in the middle of this. The metrics you see there are what our projections are. We are utilizing kind of a blunt object industry standard, which is the cap rate, to project low and high. You can see if the cap rate increases, our average annual returns, our return profiles on the left side in the red go down. If the cap rate decreases or compresses and it becomes a seller's market, our return profiles go up. We're also doing a 50-50 equity split between LP and GP equity over a $15 million exit price. So the middle numbers are projected on about a $4.85 million sale price. If we exceed that by exceeding expectations, we'll split those additional returns 50-50 with the LPs. Another thing that we like to do on all of our projects is to try to be tax efficient. We do that through cost segregation studies. So we hire an outside third-party company to come in. They break the property down into all of its individual components, and then that allows us to put them into different buckets and accelerate depreciation on the project. In layman's terms, what that means is that it allows us to push forward a lot of depreciation in the first year of ownership. So we've got about a $10 million project here. Typically, we see about 25% of total project come back in a cost segregation study as stuff that we can front load and push forward. And if you look at the example of a $100,000 investment below, you see a couple of scenarios. One, the lower one, which I'll start with, is where we currently are scheduled to be next year. For the 2025 tax years, there's 40% bonus depreciation available. And if you invested 100,000, that would push back a loss of about 24,000 in year one via bonus depreciation. If we go to what might happen or what's projected to happen for the 25 tax year, which is kind of the bringing back of 100% bonus depreciation, you can see there's a much bigger paper loss that comes through to you, which you can utilize to offset other gains or other passive gains in your portfolio. So talk to your CPAs about that, but there's a lot of great tax advantages on this project as well. So this slide is a pretty large slide. It outlines effectively our entire business plan for this project over the 10-year lifespan. I'm not going to go through every cell here, but I'm going to highlight a couple of things. One, up top, you'll notice the unit type and unit counts. It's a really well-balanced property. There are 48 one-bedroom apartments and 48 two-bedroom apartments. There's also 4 two-bedroom townhomes and 2 three-bedroom townhomes. So really well-balanced property. should lease really well. And if you look at the average kind of market monthly rents, you can see there's a major difference between year one and year two. That's us going in, adding, true real operations, real property management, real maintenance, implementing our CapEx plan, renovating units, and kind of making this property beautiful and bringing it back to what it used to be. So we're really excited to get it there and provide that level of service for the tenants in here. Another line I kind of want to highlight through here is the expense ratio, which you'll see about halfway down the page, right below the net operating income. You can see that it's over 50% in year one. That's due to the low total gross income because we're turning all those units. We're going to have very high occupancy in year one, and then you'll see it move towards stabilization in the upper 30% range, which is about what we'd expect to see of a property of this size. Um, Following down a little bit further, you can kind of see the building value. We're using the assumption of basically a flat market cap rate throughout the kind of term of this project. You can see by year 10, it reaches about $14.85 million in total value, and that's when we expect to exit. And then I do want to just highlight a couple of things really quickly below the line. You'll see the capital expenditures line item. That is basically a reserve that we build up every year in excess of all of the normal maintenance and landscaping and wear and tear dollars that we spend on the property. This is money that we're setting off to the side to take care of the property, bigger projects on the property in the long run over time. So we're not kind of like looking to put lipstick on this thing and get out of it. We're actually looking to maintain it and take really great care of it during our entire ownership period. And that budget allows us to do that. Then down below that, you'll see the asset management fees. We like to be super transparent. So those asset management fees come to us as the general partners. That's part of our compensation for running the deal on an annual basis. And then that net true cash flow line is what actually flows down through to the limited partners, and the general partners and is split at that 70-30 split. Um, One thing too, we always like to do, we really like to try to align ourselves with the limited partners as general partners. So we invest alongside of the limited partnership. We'll be investing a minimum of 5% of the total limited partnership in Class B shares in this deal. So you can kind of rest assured that we're putting our money where our mouth is on this deal, and we're participating right alongside you in the limited partnership side. And then also, again, in an effort to be transparent, we like to show our fee schedules. So this is how we make our money on this deal. There's three fees that we get paid basically at closing when we buy this deal. One of them is an acquisition fee. We charge 2% of the sale price. One of them is a construction fee. That's 3% of the total construction budget. And then one of them is a loan guarantor fee, which is 1% of the loan amount that's outstanding on the property. So those are already built into that, roughly $10 million that we showed you in terms of the total capitalization for the project. But we just wanted to break them out and show you here. Also, ongoing or down the line, we get a refinance fee of 2% of the loan amount at refinance, and a disposition fee of 1% of the sales price when we sell the property. So those are kind of our kickers throughout the project. This is a wordy slide. You guys can kind of all read this at your leisure. I do want to highlight just a couple of notes that we haven't touched on yet. So risks, a limited partner is effectively limited to the amount of their initial investment in terms of the risk they're taking on with this deal. So if you invest $100,000 in this deal and the project completely fails, goes totally sideways, and there's lawsuits, et cetera, et cetera, your risk is that $100,000 that you invested. Your limited partner, that limits your liability. We're the general partners in this deal. We're signing on the loan. We're signing on the construction agreements. We're the management company. We're kind of taking on all that risk. So just like to make that well known. And then from the reporting side of things, we try to be very open and honest with all of our limited partners. We provide detailed quarterly reports. A lot of you on this call already know that. You see the reports from our other deals that we've done. Those are written by me. They come out 2 or 3 weeks after the end of the quarter. They provide all kinds of details, everything from kind of construction budget details to construction updates to rent rolls to the P&Ls for the property on a monthly basis, and then kind of a rolled up P&L. And anything that's not in there that you'd love to see in there, we're happy to provide, and we're easy to reach. So we like communication. I love to get feedback on those reports. And it's one of my favorite things is kind of compiling those and pulling them out and putting them out to everybody every quarter. So this is a broad overview of the investment kind of timeline here. There'll be a little detailed kind of setup of where we're going, like right at the end of the presentation, but broad strokes, April 21st is the funding date that we're looking for funds to come in from limited partners. May 28th is our scheduled closing date. Then that next year you see is kind of blank. That's when we're kind of standing the property back up again, implementing all of our CapEx plans and our management. And then you'll start to see initial distributions in Q3 of 2026. Q1 of 2029 is when we hit that refi timeline, when we push back all of the Class A balloon payment, and then we also push back approximately 60% of the initial investment for the Class B LPs. And then for the next, 6 years, we basically ride the deal. We do our normal quarterly distributions, we operate the asset, and then we sell the asset in 2035 and cash everybody out completely.
Awesome. Thanks, Eric. Now I'm actually going to get into the asset itself and the market. So we kind of front run this presentation with the deal details, which we think is the red meat for you guys, and then we'll get into what this actually looks like. So, as you can see from the pictures to the right, this is kind of what the property looks like today. Frankly, it's mostly classic, which means as it was built in 1978, with some new paint, new carpeting in some cases, new flooring in some other cases. But it's frankly, it over the course of its lifespan has gone through different ownership groups, which have done different things in terms of their investment in the property and their lack thereof. The current ownership group really hasn't done anything in the last 5 to 7 years. I don't even know if he's been to the property since COVID. It was a dual partnership group. One of the partners kind of fell out, and then the person we're working with to acquire the deal um, is a nice enough guy. He owns a bunch of stuff in another part of the country, but he just never makes it out to this property, and you can tell. The upside here is that it's a great basis for us to come in and kind of inject our business plan. It's situated on 20 acres, frankly, of quite beautiful wooded land, with some opportunity for nature trails and things like that if we get to that down the road. The layout itself, it's comprised of 5 buildings that are 3-story apartment buildings and one 6-unit townhome building. And it's basically just south of Meadville, minutes from downtown Meadville and Allegheny College, right off of I-79, which is about, for those of you outside of the area, it's about 80 miles north of Pittsburgh. It's about 45 minutes from where I'm sitting right now in Zelienople. Um, and yeah, so this is kind of what it looks like today. This is an aerial of the site map. Again, basically just zoomed in on the development itself, not the entire parcel. But you can kind of see the layout here. And so, if you go on Google and you look up Timbercrest Apartments, it's got a very low rating, which we're going to change, obviously. But the number one call out is the potholes. And we were all up there yesterday, actually meeting with 3 different asphalt companies to get bids on resurfacing this lot, which we have in our budget, of course. But the parking lot is in terrible shape. And so it is the number one thing you ask a waitress at lunch, what do you know about this apartment complex? And the first word out of their mouth is potholes. So the fruit is low hanging, and we think that the ceiling is very high on this property, in terms of potential. Crawford County, I'm not going to read every word on the slide, but I'll hit the highlights. So, Crawford County is located in northwest Pennsylvania. It's comprised of about 84,000 people. Um, Very, very low unemployment rate, actually. It's 3.2%, which is below the national average. The main industry here is manufacturing. So it's kind of the dominant industry. It accounts for almost all of the GDP. It supplies about 8,000 jobs locally in the county. And companies like Accutech Precision Aerospace, Channel Lock, which is a big one, Greenleaf Corporation, many, many others. So it's a manufacturing hub of kind of Western PA. Timbercrest is located basically in Meadville, just south of downtown Meadville, which is the largest city in Crawford County. It also ranks as the number one best location to live in Crawford County, according to niche.com, for a number of reasons, but it's a quaint little college town, frankly, that's situated between a few tourism attractions. So it's well located in terms of access to I-79, which is the major north to south corridor in Western PA. Meadville itself is home to healthcare. Meadville Medical Center is a big employer in the area, as well as Allegheny College, like I mentioned. And then the state parks. So Pymatuning State Park and Conneaut Lake, they're 5 miles west of Timbercrest Apartments. They attract over 2.5 million visitors annually. It's the second most popular state park in Pennsylvania. So there's a lot of economic impact from that kind of visitation as well. So by the numbers, you can kind of see where this is located behind this graphic, kind of in the northwestern corner of the state. This is squarely blue collar, kind of like what we were teeing up in the beginning of this presentation. So median household income is around $60,000. Average value of a single family home is around $150,000. Um, rental housing, makes up about 30% of the total. And basically, like the gap between people that can afford to rent and afford to buy homes is when it comes down to hourly wage, only about a $5 difference, but it's significant enough that it really does drive the rental market here. There's an abundance of people looking for high quality rental housing that just doesn't exist, and that tees up a really good opportunity for us. All right. So for those of you who don't know us here at Rice Pegger, I'll provide a quick overview, and then we'll get to the Q&A. So we're a vertically aligned commercial real estate investment company, and I think one of our biggest differentiators is our hands-on approach to these deals. Eric and I and Clayton are very involved, as well as our supporting team, in every one of these deals. Like I said before, we're about 45 minutes away from Timbercrest. We were there yesterday. We will be on site quite a bit getting this project stood up and ensuring that our business plan is executed properly. Things that differentiate us are our relationships in our market with brokers that allow us to get deal flow, our in-house property management, in-house maintenance, and in-house general contracting. That allows us to take a design build approach that is economical, frankly. So we're really good at doing layouts that are modern, that feel great to be in, that use good materials, but that are also very affordable, which allows us to essentially pass back all that affordability and all that upside to investors and general partners in these deals. So that is a differentiator for sure. Something else that we pride ourselves on is service oriented, property management, transparent reporting, not only for our investors, but also for our tenants, frankly. They have access to us through Buildium, which is an app that they have on their phone. It makes paying rent very easy. It makes submitting tasks to maintenance very easy. So all in all, we're able to provide a very high quality product at a reasonable price. In terms of who we are, in terms of scale and tenure, we've been around doing this since 2017. To date, we've got about 30 million in assets under management. We've raised about 5 million in funds under management, everything that we don't own individually at Rice Pegger, that's been syndicated from folks like you. Our current cash flow is about annual revenue is about 2.4 million annually. That number continues to go up as we grow. And basically our bailiwick is workforce housing. Like, we focus on value add workforce housing as our scale model. We do some Main Street historic renovations, specifically in Zelienople, where I'm sitting right now. But really, our growth mechanism is value add workforce housing in the Western PA region. It's a stable asset. It, is something that frankly is deteriorating. There's not enough of it. And the demand for it is essentially, outsized and not going away anytime soon. So we can't build it fast enough to take advantage of all that demand, and that's what we focus on. The general partners in this deal are Eric Rice, the CEO, myself, and Clayton Pegher, and we're supported by a great team. So from the management perspective, David Coutone is our regional property manager. David comes to us from a bigger firm locally here. He's got an abundance of experience in this line of work, with some excellent SOPs and management skills that he's going to bring to this particular deal. So we will be staffing an on-site property manager and leasing agent, as well as a maintenance tech. All of those folks will roll up to David. who will implement the Rice Pegger SOPs that are tried and true to get this property up to speed. We're also supported by Janet Devlin, who's our accounting manager. Janet is an excellent accountant and bookkeeper who basically will ensure that all of our numbers are correct, our bookkeeping is accurate, and our K1s are done on time. So she will be, helping facilitate payouts as well as tax documents and things like that. We're also supported by Meyer Unkovic and Scott, who's our uh, basically our attorneys and our legal advisory board. They will help us with all of our documentation for this deal. And finally, we're supported by Lally and Co., who's our CPA partner in our business tax advisory company. So this is the team. Really quickly, you guys have, if you're familiar with us, you may have seen this case study before. The reason I bring it up again is because it is an example of a heavily distressed value add success story. We acquired a condemned, entirely vacant 62 unit portfolio in 2021, and we brought it back to life. And frankly, it's the best product in the market. And so you can see here the return profile is exceedingly strong. In Q3 of 2024, we refinanced this into agency debt and returned 118% of our investors' initial investment with that. So it's a great success story. It's a much heavier lift than the one that we're presenting to you here, and we think it speaks to our kind of experience in this particular vertical. All right, next steps, and then I'll stop talking for a second and hopefully hear from you guys. So, we want investor commitments through Invest Next by the 28th. Invest Next is our investor platform. There's a link to it in that initial email Eric sent. If you have any questions on that, email me or Eric, and we'll get you in there and set up. It's super easy to use, and we'll include all your documentation there. And that's how we track everything. So that would be great to have that in there by the 28th. We already have a few in there already. So thanks to those that have already entered those commitments. By April 1st, we should have your private placement memorandum for review. We're currently working on that with our attorneys now. And then that will give you time to review that and get funds in place to wire by the 21st of April. We'll be looking for funds at that point as well as signed documents at that point, all ahead of closing on May 28th. So this is the timeline. If there are any questions, please don't hesitate to reach out to Eric or I. All right. That brings us to the end of the presentation. That was a lot of info. We got it done in just over a half an hour, which is a speed record for us. But we want to hear from you. So I'll open it up to the group. If there are any questions, please chime in. Not everybody jump in at once. I see a bunch of anxious people waiting to ask questions. I can tell.
Hey, Patrick, this is Patrick Warden. How you doing, man?
Hey, what's up, Patrick? I'm good.
Hey, I had a quick question. Could you just really quickly go over the facility improvement plan and what the new rent per unit looks like
Yeah.
after the additions
Yes. I'll
or
navigate back to
renovations?
that.
Sorry.
Yep. Let me get back to that slide and then we can go through that. So the right off the bat, we're going to tackle 50 units, full turns. So and we have more detailed like spreadsheets and things that we can share to anybody that wants to see them, and Patrick will certainly share them to you. Um, so what I'm going to show you here is just kind of the rent roll, and then we can get more specific in the
Mhm.
follow-up. But basically, we're going to tackle 50 units within the first year that will get full turns, and that means like new kitchen cabinets, new appliances, new flooring, paint, the whole works, right off the bat. And so that's going to come from the down units currently. And then we feel like when we push everybody to market rent, which is, they're significantly behind that now, we'll get some attrition there. And then we'll be able to turn the remaining 30 or so units in that 1 year timeline. And then after that, we'll turn, Eric, how many is it per year after that? Basically, the remaining units per year from years 2 through 8 will get
Yeah,
turned.
it's
Um,
it's about ten units per year
yeah,
once we hit year three. And so we'll kind of move through them as they kind of naturally move out. And then I think one important thing, and in the more detailed pro forma, you can see it, but the rent delta between, remaining classic units and upgraded units is approximately $100. So it's not a crazy rent delta between where we're taking the new units and where the old units will move up to. Um, but it's enough that it'll cause a little bit of attrition, but it'll also allow us to potentially roll some of the current tenants into new renovated units there. Instead of them moving out of the complex, they're going to see a lot of improvements and upgrades happening, and they're going to have an opportunity to move into a new unit if they want to as well.
Awesome. Thanks, guys. Just a couple follow-up questions related to that. So the initial, what did you say? You said it was 50 you're going to renovate?
Yep.
Are those like partially vacant slash are those leases coming to term? What's the strategy there to like churn out the existing tenants?
Yeah, so there's about 20 vacant units right now.
Okay.
And that's like kind of what Pat was kind of speaking to with the current folks that are on staff there are strapped financially by the ownership group that's there now, but also
Right.
they're just not really probably the right people to be in the roles that they have.
Mhm.
And so there's literally units that we walked yesterday that need to be cleaned and they need an HVAC unit and they're rent ready. Like they're classic, but they're rent ready. Like they could fill them with their wait list, but they're not getting the support to do it. Like the maintenance technician, I asked him what his operating budget was on a monthly basis, and he's operating out of the coins that he collects from the laundry machines. That's his operating budget. It's insane.
Yeah.
Yeah.
Wow. And then just an additional question on rent after renovation. Is that like 10% above market? I mean, you guys do a great job on your renovations, and I'm just thinking, high level here. If you're renovating, one of the only workforce housing places in town, I feel like you have a lot of leverage to, ask for slightly above market rent.
Yeah, so we're above like the base market rent, like the middle market rent,
Yeah.
but below like there's another level up that starts at like say $1,200 to $1,300 for one bedrooms and
Mhm.
two bedrooms go up from there. So we're right in like a kind of an empty no man's land in terms of where we're able to move the rents to because we're going to provide like almost the same level as those 12 and $1,300 units, but we'll be, 150 to $200 underneath those.
Okay. Got it. Thanks, guys.
Yep.
Oh, I had a question. What's the current tenant profile look like, and is there going to be any change in your when the rent units are renovated?
Go ahead, Pat.
Yeah. So current tenant profile, and this is somewhat anecdotal. I mean, based on our site visits, which we've been there a handful of times since this started, folks that work at department stores, people that work in manufacturing, age ranges is kind of all over the place. The young woman I spoke to who works at I think TJ Maxx is probably in her late 20s. We have everybody from that cohort to middle-aged and senior citizens there. In terms of what that renter profile looks like post renovation, it's going to be a lot of the same. I mean, it's that kind of workforce tenant that I was describing in the presentation. So, folks that are non-professional, non-white collar, but work in supporting industries, whether that be entertainment, restaurant, retail, manufacturing, construction, things like that. And there's an abundance of folks in that region that frankly need housing that we're going to provide. That just the other options, if you go on Zillow Rental or whatever and look at other apartments for rent at that $850, $900 price point for one bedrooms, you see a lot of student housing in Meadville. That's frankly pretty bad, or just like really decrepit kind of single family homes that are not very appetizing. And then, like Eric said, above it, about 12 to $1,400 for one bedroom. There's patio home complexes, but that's just kind of out of the reach of the tenant base that we're really speaking to. And then David Catone, who's our regional, he has helped us define our criteria for people in terms of credit scores and background checks that we rent to. And those are extremely clearly defined, and it helps us get people, that are going to be able to afford to live here, and afford to pay on time and hopefully be long-term tenants, which allow us to keep a stabilized, healthy property.
Yeah, just a quick add to that too. I mean, it's one of the benefits of being kind of best in class in this kind of workforce housing apartment class is that we also get the best in class tenants in our properties with our screening techniques. So we tend to have a very nice solid like tenant profile, and that's just kind of I think a benefit of the product that we put out, and then a benefit of the management and the service that we provide.
Thanks. Great job, guys.
Thanks, Bob.
Hey, Eric, Pat, this is Brent here. I just have a couple questions for you. So first, thanks for putting this together and great job. Um, so you guys were just talking about like the rent, the units you guys are going to be, kind of turning here. So it sounds like the majority would be done by what the year four refi point, and then after that it would be about 30 to 40. Is that what the plan would be from? Because obviously you're going to
Yep.
maximize, I guess, the appraisal value at the time of refi. So based on what you said, I think 10 units per year after year four. Does that sound about right? Up through year eight?
That's right. Yeah.
Yep.
And that's what, and if you look at the percent change in income on this rent roll document here, um, we bake in just a 3% annual increase to our lease. So anything you see above 3%, that's the remaining units getting turned kind of on the tail end in year 7 and 8. You can kind of see that tailing off there. But yeah, by year 4, we should have
So
at least 60 of them done, maybe 70
60.
at the time of the refi.
okay, that's helpful. And then I did see on like Google Maps, like looks like there's a swimming pool. You guys have any thoughts on what the plan is with that?
Yeah, we were using that yesterday. It's really nice. No, it it hasn't been operational according to their maintenance technician since at least 2017. So we're gonna remove that pool completely and turn that area into like an actual playground complex. So we've got money budgeted in our CapEx plan to put a legitimate playground there. There's also a tennis court complex down below that that is they put in a pretty low-lying area, and so the asphalt down there has always been an issue for them. It's never been utilized or touched in the past 7 or 8 years either, and so we're going to probably convert that into a nice dog park for the complex. So we're gonna provide a couple of amenities like that you don't find in complexes like this as well. So we're excited to do that along with a significant landscaping plan. I mean, the property really is beautiful. It's like mature trees, lots of space, and so we were meeting with our landscapers out there yesterday as well, and they're crafting their plan right now in terms of how to get this thing really shining and looking great.
Okay, great. Yeah, thanks. And then just the last question is, I know you mentioned a sale price. You said, I guess, is it just the incremental amount over, I guess, like a 15 million sale price would be split, I
That's
guess,
right.
50 versus the 70-30. Is that right?
Yep, exactly.
Okay.
Yep. So it's 70-30 up to 15 million. Anything over 15 million goes to a 50-50 split. And in that high side projection, Pat, I don't know, can you pull up that slide really quick?
Yeah.
And that high side projection, that's already taken into account with those return metrics that are shown there.
Okay. All right. Thanks, guys. Appreciate it.
Thanks, Brent. Pat, Brad asked if you could bring up the investor term slide again.
This one?
I don't know. Maybe come off mute, Brad, if you want.
Yeah, I didn't want to bring it up on this slide because I was a little late and I didn't want to interrupt your
Oh,
guys's
no, yeah.
flow, but great presentation and property looks good. But yeah, maybe Eric or team, I can catch up with you guys on this piece after the call. So I came in right after this slide, apparently.
Yeah, absolutely. We can do a call.
Brad, you've got the best Zoom icon with the Step Brothers image. You
My partner and I change Will Ferrell images for every week,
Oh,
basically for our clients, and
very
and
good.
only dudes respond.
That tracks.
Yeah.
Great, guys. If there aren't any more questions, I'll give a couple seconds for people to jump in, but I am recording this, so I'll cut this down and post it to a shareable link, and I'll send this around. And as I've said a million times, if you have any questions, don't hesitate to reach out. Eric and I are ready and willing to answer any questions, jump on any kind of call. And then just as a reminder, here's the timeline. And like I said, if you have any issues with Invest Next, just let me know and I'll get you in there and set up. We'll also be putting this presentation there as well. The documents will live in the Invest Next deal room. So everything will be kind of consolidated there. Well, if there aren't any more questions, I think we could probably stop it there. So thanks everybody for joining. We're super excited about this one. We appreciate your engagement here on the call, and we'll be in touch.
Thanks, guys.